For decades, U.S. Treasury bonds have been regarded as the epitome of safety in global finance, a benchmark for stability and reliability. Nations worldwide have invested heavily in these instruments, reinforcing the United States' position at the heart of the global financial system. However, recent developments have raised critical questions about this long-standing paradigm. Reports indicate that several allied countries, including Japan, Saudi Arabia, and the United Kingdom, are reducing their holdings of U.S. Treasuries. This trend prompts a deeper examination of America's financial dominance and the potential shifts in global economic alliances. This video explores the reasons behind this shift, the economic and geopolitical implications, and what it could mean for the future of the U.S. dollar as the world's reserve currency. The shift in global bond holdings. Traditionally, countries like Japan and Saudi Arabia have been among the largest holders of U.S. Treasury bonds, viewing them as secure assets that underpin their foreign reserves. Yet, recent data suggests a notable decline in these holdings. Several factors may be contributing to this shift. The United States national debt has surpassed $34 trillion, raising concerns about the long-term sustainability of its fiscal policies. Investors and foreign governments worry that continuous borrowing could lead to a devaluation of the U.S. dollar over time. To combat inflation, the U.S. Federal Reserve has implemented higher interest rates, which, while aiming to stabilize the economy, have made existing bonds with lower yields less attractive. New bonds with higher interest rates cause the value of older bonds to decline, making them less desirable to hold long-term. Third, geopolitical tensions and sanctions. Countries like China and Russia have actively reduced their holdings due to political tensions and sanctions imposed by the U.S. government. The freezing of Russian foreign reserves after the Ukraine conflict has led many countries to rethink their reliance on U.S. assets. Impact of rising U.S. interest rates. The Federal Reserve's decision to raise interest rates has a direct impact on the bond market. When interest rates rise, newly issued bonds have higher yields, making older, lower-yielding bonds less attractive. Foreign governments holding large quantities of these older bonds suffer significant unrealized losses. This can lead to a decrease in demand for U.S. Treasuries, making it more expensive for the U.S. government to borrow money in the future. A potential consequence is a bond sell-off, which could weaken the U.S. dollar's standing as the global reserve currency. Exploring alternative reserves. With these concerns mounting, many nations are actively diversifying their reserves beyond U.S. dollar-denominated assets. This includes gold purchases. Central banks worldwide are increasing their gold reserves as a hedge against currency fluctuations and economic uncertainty. The People's Bank of China, for example, has been consistently buying gold for over a year, reducing reliance on U.S. bonds. Second, alternative currencies. The euro is emerging as a stronger reserve currency, with European leaders advocating for its expanded use. Pascal Donohoe, the president of the Eurogroup, recently highlighted the euro's potential to rival the US dollar, particularly as the EU increases its fiscal spending. Cryptocurrencies and digital assets countries like El Salvador have experimented with Bitcoin as legal tender, while China has introduced its own digital yuan. The rise of central bank digital currencies, CBDCs, could create alternative reserve assets that challenge the dominance of U.S. Treasuries. Case studies: how major players are adjusting Saudi Arabia. Historically aligned with the U.S. through the petrodollar system, Saudi Arabia is now strengthening ties with China. Talks of conducting oil transactions in non-dollar currencies, such as the yuan, indicate a potential move away from dollar dependency. If Saudi Arabia shifts even a portion of its oil trade away from the dollar, it could significantly impact global financial markets. Japan. Japan, once the largest foreign holder of U.S. debt, has been gradually reducing its Treasury holdings. Domestic policies aimed at revitalizing the Japanese economy, combined with rising interest rates in the U.S., have made holding U.S. bonds less attractive. Increased defense spending and regional security concerns are also leading Japan to reassess its foreign asset portfolio. Not United Kingdom. Post-Brexit, the UK is redefining its financial strategies to establish itself as a standalone global financial center. This includes reassessing its foreign asset portfolio, leading to a reduction in U.S. Treasury holdings in favor of investments that align with its new economic objectives. The UK's moves reflect a broader trend among European nations seeking greater financial autonomy. Potential consequences for the US. If the trend of reducing Treasury bond holdings continues, several key challenges could emerge for the US. Higher borrowing costs. Reduced foreign demand for treasuries could force the U.S. to offer higher interest rates to attract buyers, increasing national debt servicing costs. Weakened dollar dominance. If major economies shift towards alternative reserves, the U.S. dollar's role as the primary global reserve currency could diminish. This would make international trade more complex and potentially weaken the U.S.'s geopolitical influence. Increased inflation risks. If the dollar loses value, imported goods could become more expensive, contributing to higher inflation within the U.S. The future of the U.S. dollar as the world's reserve currency. Despite these challenges, the U.S. dollar remains the dominant reserve currency for now, with over 58% of global foreign exchange reserves still held in dollars. However, the shift away from treasuries signals a changing global financial landscape. The rise of multipolar financial systems could lead to a world where multiple reserve currencies coexist. The U.S. may need to adapt by focusing on stronger fiscal policies and international partnerships to maintain confidence in its financial system. The ongoing shift away from U.S. Treasury bonds by major global players is a significant development in international finance. While it does not signal an immediate collapse of U.S. economic dominance, it does highlight concerns about debt sustainability, geopolitical shifts, and evolving financial strategies among allied nations. For investors and policymakers alike, these trends are worth watching closely. Will the U.S. adapt to these changes and maintain its financial stronghold? Or are we witnessing the early stages of a new economic era? Let me know your thoughts in the comments below, and don't forget to like and subscribe for more deep dives into global finance. Thanks for watching.